So give us a quick explanation. What exactly is private equity and how does it differ from different types of investors?
Great. So private equity is an investment strategy that's an alternative to public market investing, right? So people could invest in stocks or bonds. They could buy, a share of Microsoft. But there's a whole group of investors that basically choose to buy private businesses, and basically the cash flow and the improvements when they ultimately sell it are what drive the financial returns. And so typically they're funded by endowments, from universities, pension funds that are managing the retirement money of different retirees, and ultra high net worth individuals. And ultimately, private equity has a typical approach of how they invest, which is they will buy into a business, but they have to essentially exit their business or exit their stake within a period of time that's stipulated in their agreements with their investors. And it's typically 5 to 7 years.
Okay.
So what you'll typically find is they make their money in the exit. They're experts of buying something, improving it in a variety of different ways, growing it, and then ultimately selling it. And that's how they make the profits that both provide the returns for their shareholders, but also the private equity investors are making a share of that profitability, and that's what induces them to do it.
Okay. So why is the private equity playbook so valuable for everyday business owners, even those who aren't actively looking to sell? I think we talked a little bit about this yesterday. You got to go look for that extra money, extra thing, the opportunities, even when you're not necessarily ready to sell.
Well, and in general with capital, the best time to look for capital is when you don't need it, right? When you're in the crunch, nobody's willing to give it to you, right? But when things are good is ultimately. I think the reason why private equity is instructive is essentially, these are guys that professionally, they select the best talent in the world to execute a strategy to take private businesses and maximize their exit, right? They're making, a percentage of that profit. And so over years, they've systematically created a playbook that, maximizes the profitability of it, right? And they have a variety of different tactics that are used. One of the most traditional sources of value for private equity is using a lot of debt. For some people, there's many people that don't like debt, right?
Okay.
And that's okay. But I think what's valuable is at least to say, okay, let me take a look at the range of different tools that they use and cherry pick which ones could be applicable to me, or which ones do I feel comfortable in using it in my business, because all of them are potentially valuable in terms of growing. So I'll name two typical kind of tactics that you find. The first, which I think is very basic and elementary, but is very helpful, is essentially that private equity, before they even buy it, before they write the check, they have what's called an investment thesis. So they already know 5 years from now, more or less, how big they want to get it to, who they want to sell it to, what it's going to look like. And they essentially work backwards. And they basically say, well, in 5 years, if I'm going to be 500 million and we started at 100, just to make the math simple, well, at the end of year one, I need to be at 150. And at the year of two, I need to be at 250. And, let's say using a manufacturing business, well, what is it going to take in order for me to get there? Well, I may need to have X number of salespeople to have that type of growth. I may need to have a larger facility to have that type of growth. So everything is basically tied into a comprehensive strategic plan that they start from the beginning and try to execute upon. And what they then do is, on a consistent basis, frequently on a weekly basis, they hold themselves accountable to it. So they say, okay, based upon where we need to be at 150 and at the end of the year, we're 1 month in, what are the things that we need to accomplish in order to track to be able to achieve that? And so in a lot of ways, it's less about the plan and it's about the discipline of holding yourself accountable to, hey, this is where we expect to be. And if we're not, how do we catch up? And how do we hold accountable our team as well as incentivize, right? Private equity also uses a lot of techniques like sharing equity or, other types of profit sharing or bonuses that can incent other people's, particularly key people in the team to be able to get, to the next level. The second, and there's a lot of other tactics, but so we don't kind of go down a rabbit hole. I think the second one that's relevant is there's a phenomenon out there, which is a big business in the market is worth more pound for pound than a small business. Businesses are typically valued as a multiple of EBITDA or your profitability. And so what do creative private equity professionals do when they see that phenomenon, which has been around for a long time, is essentially say, well, let me put lots of small things together that I can buy relatively cheaply and sell it as a big package and get a higher amount for the total thing. And so essentially what they're doing is they're making the spread between what small things they can buy for and the big thing of which they can sell.
I've actually been seeing that trend a lot in Florida in the landscaping industry. A lot
100%.
of big hedge funds are coming and they're buying up a ton of smaller companies. So, yeah.
And, I think it's important that people are aware of private equity, because even if you don't want to copy it, you say, I don't want to do any of that. The reality is that private equity is shaping and impacting a lot of different industries. Because of that consolidation, you have a lot of companies, I know different companies of, for example, distributors or manufacturers, and they have distributors. Well, a lot of the distributors are getting bought up by private equity. And so it's changing the dynamics where you may have had 30 customers before, and all of a sudden you've got 12 or, whatever it might be. So it's also important to be aware of it, because it is basically the leading edge of what's typically happening across a lot of different industries, which is consolidation. And consolidation often helps with regards to the profitability and the value of a business. But in terms of other companies in the ecosystem, it can be very disruptive. The pricing can go up, you can lose a customer, stuff like that. So it's something to be aware of.
To be aware of. One of the things that David always says is first impressions matter. From a buyer or investor's point of view, what are some of the first things that a private equity firm or an investor, they look at in a business?
Great question. To me, first impressions and everything are essential, because people kind of make a split-second decision, and then afterwards it takes so much effort to overcome that inertia in terms of changing what that initial viewpoint is. So, first and foremost, financials are obviously something that investors are highly, they highly prioritize, because that's the critical element that they're analyzing. And so making sure that your financials are clean and have everything where they reconcile, and all the backup documentation is definitely a key element that is important, because even if your numbers are great, but they look disorganized, the level of confidence that somebody has in it from the beginning, you're starting off on the wrong foot. Yeah. But the reality is that that's kind of, in a lot of ways, secondary, because most of the time, private equity is not going to see your financials up front. You're first going to, typically when you sell, an advisor or somebody else will go and have relevant buyers sign a non-disclosure agreement. Once they sign that agreement, then they'll be able to see actual numbers. So what typically happens is their first impression tends to be whether it's your actual storefront, or more likely than not, your website. And people will make split-second decisions around, looking at your website and saying, hey, this company feels like it's from 20 years ago, or this is a cutting-edge business. And it starts with a Google search, right? So it's not just your website, but when you're on a Google search, what's coming up on your reviews? What is coming up in terms of, whether it's a lawsuit or an investigation or anything else like that. And so when you think about how do you curate it, aside from there are reputation management folks that can help with coming up with strategies of improving your ratings and all of that, a lot of businesses, when they have enough time in advance, will spend some time and energy actually hiring a communications or a marketing, advertising, PR firm that will help them get additional good publicity that can help tell their story in the best light possible. And ultimately, it may be purely just for, with the intent of when an investor Googles them what do they see and what's kind of the initial impression that they get, from it. But, the reality is it goes throughout. So, let's say you have a manufacturing company or whatnot, eventually somebody will, before buying a company, do a walkthrough. And so, whether it's neat and tidy, all those things send a signal around what's the culture in the organization, and gives a little bit of a sense to the buyer of what it would feel like to own the business, right? And you walk into a house that's staged beautifully, it has one feeling. And in fact, I heard yesterday people saying that they bake cookies, to create that home feeling, and it's a very intentional experience versus walking into a house that a hoarder just lived in and there's no preparation. Clearly, you're going to have a very different response and value ultimately.
It's interesting that you say that because yesterday we had our Are You Lender ready, and the bankers and the lenders, one of the first things that they said is, we'll give you money based on the story that your numbers tell. Mm-hmm. So it's interesting to hear that there are other things that matter when you're looking to sell your business. On that same lane, in your experience, what separates a marketable business and one that's unsellable?
That's a great question. So the statistic is that only about 50% of businesses are sellable. And for a lot of people, that's pretty shocking. And I'll kind of go to the root of what makes something unsellable, which is you have to put yourselves in the buyer's shoes, which is most buyers, you think about it as a big fund or a big company, but the reality is there are individuals that are employees that work for that company, right? And the easiest thing that will get them fired is essentially telling their boss, yes, I want you to write a big check, and then something happens, and the next week, all of a sudden, everything got lost, right? So I like to describe it as existential risks, right? Certain risks, even though their likelihood is very low, the outcome would be so catastrophic that essentially it makes most buyers say, at any price, it's just not something that I'm willing to do. Unfortunately, when a business is unsellable, what it means is their best outcome will ultimately be either to transition it to somebody else or to liquidate it. So essentially, to shut it down, to collect all the money that's owed to them, and to stop operations. So what do I mean by existential risks? I mean things such as customer concentration, right? So it may be highly unlikely that that big customer that represents half of your business leaves you. But the buyer doesn't know that, right? And the buyer is thinking just about that worst case scenario. And so customer concentration is one example of an existential risk. Another one, which is a lot less technical or just very basic and very common, is what we call key person risk. So there's some businesses where the individual is so important to the sales and so important to everything that, God forbid, something were to happen to them, the whole business would unravel. And that's something which ultimately is a lot easier to fix than, for example, customer concentration, but is easier said than done, right? In terms of building up the team. And actually, the hardest part, I find, is for the business owner often to let go and to delegate. But there's some other things. For example, litigation, right? If you had, if your company's worth 10 million, but you have a lawsuit that could be worth 5, it's so big relative to the, to the company size that it almost is impossible to get around. Similarly, investigations or, different kind of governmental inquiries and all that can be very detrimental because, these private equity investors, since they're funded by pension funds, are highly sensitive to the being politically correct and not being in the news for the wrong stuff. So the worst thing is for them, even if it's the best investment, if they're in the 6 o'clock news because something bad happened or whatever, no amount of profitability generally will induce them to do it. So those are a couple different, categories. the reality is that almost all of them, if you have the luxury of time, can be addressed, right? So it's one of those things that if you say, well, I want to sell tomorrow, that might be really difficult. But if you say, look, I've got a couple years, then you can intentionally work on it. And going back to, the private equity, planning that I was talking about, okay, well, I have a lot of customer concentration. Well, what am I going to do about it? Well, by the end of this month, I'm going to have, 10 meetings with, other, potential large clients. At the 6-month mark, I need to have landed at least 1 or 2. And you basically hold yourself and your team accountable to getting there and ultimately, improving whatever is that, detractor to your sellability.
So it's not an exact science, but I guess you're setting the trend for what kind of companies that a private equity firm would look for. What are some things that these businesses can do to sort of set themselves apart, to make themselves their businesses ready to sell? And what kind of advice would you give to them?
Look, I think first and foremost, what private equity cares the most about and investors care the most about is the financials, right? So strong profitability and growth of it is the most important, right? Having everything else, but without that, is not, really valuable. But if you put that aside, private equity, particularly since they're in the business of trying to use debt as a large portion of their investment, and they're doing that, just for the record, just like instead of buying a piece of commercial building 100% with cash, you're going to use a loan to purchase a portion of it because you get a better return with it, right? So because of that, they are almost directly aligned with what banks prefer and what banks find most financeable, right?
Okay.
So there are certain industries that they tend to prefer because of that, because of the relative stability of it, but also what we call quality of revenues. What I mean by that is every dollar of sales is not created equal. If you think about it like a spectrum, on one end, there's revenue, which is a subscription that occurs every month. You pay the fee. In fact, you are legally obligated through that contract to pay for the next few years. That is the holy grail of what an investor pays for, because ultimately they can rely upon that. In the healthcare space, value-based, models have a lot of those elements, right? Because every month what is, the payment that you're going to receive. The other extreme is basically stuff that's project-based. So it's discretionary. It's every once in a while somebody can defer it. And so things like, for example, a construction company that's doing, home remodeling is going to have a much lower valuation and appetite because, God forbid, there's a recession or whatever. Yeah. It's much easier to, to lose that. And in between those 2 points, there's plenty of things which are, somewhere, in between. So, there's a lot of businesses that may not necessarily have contracts, but they have recurring customers that come in all the time. And what's really important is to be able to show, ideally with data, to buyers and investors, that these are customers that we have on a repeat basis, and therefore we can expect going forward, to continue along. Interestingly, just the last thing is, there's a really interesting example so car washes, pretty basic business, weren't a lot of buyers for them, probably before 15 years ago, definitely, or 10, 15 years ago. And then there were some creative entrepreneurs that had basically a private equity background, and what they did was they changed it from pay for each wash to a subscription model. Yes. So you see all these tunnel washes, El Car Wash, and a variety of other names, and they're charging you $50 a month. Those are particularly attractive and actually have sold, in the past few years for almost 20 times their profit, which is wildly expensive. In particular because it has a subscription model and it has very low labor costs, right? Okay. They outsource the vacuuming to you. They essentially have 1 or 2 people on site that are there to open it up, to refill the chemicals. And so that's another element that makes it. The last thing I just wanted to mention is we're living through a very uncertain time, right? With changes that are occurring governmentally, with tariffs, with all of that. And so I would expect to see some shifts in terms of what they focus on, over the coming, few years relative to before, because I personally have been seeing in the past few weeks, businesses that may have done very well, but had, for example, 80% of their materials came in from China, and essentially, it's unclear what's going to happen with the tariffs. But no investor wants to spend particularly top dollar for something of which they have no clue. Is this going to make money, or is this going to, is this going to have a real big problem and have to shut down soon?
So it's interesting that you said that, because one of the lenders yesterday, when I was speaking with him, he was saying that right now, what they are looking for are manufacturing companies. And he said, if I know anyone that's in manufacturing, that is what they're looking for. They're looking for in-house manufacturing. So I see that the trend is sort of changing a little bit. You talked about valuation. How are companies valued? Like, what is the process? What do you go through? How do you know if you're valuable?
So from a valuation standpoint, I think the first point that I want to make is it's incredibly subjective. Unlike selling a house or a piece of real estate where everything is public of what it sold for, the actual data of what a business sold for in the past is very, very sparse. You're talking about, ultimately maybe in the entire United States throughout the year, about 100 to 200 data points are available publicly, right, of what a company sells for. And I think it's important for people to understand that, because it's not some black magic that your company is worth X. The best approach to know exactly what your business is worth, the only way, is to actually put it on the market and to sell it. But there's the way to be able to estimate it through essentially triangulating. And essentially, if you think about it, they're valuing the business through essentially using an analogy. They're saying, here's another business that sold recently that's in the same industry, that's around the same size, and it sold for this. But it has a little bit different characteristics. And here's another business that has exactly the same characteristics, but it sold 5 years before. And ultimately, it will give you directional guidance of what your business is worth. On average, if you look at the middle market, businesses will sell for around 6 times earnings. So in other words, if you make $1 million of profit, you would sell the business for $6 million total. Okay. Now, what I want to explain is essentially there are 3 drivers of why a multiple would be higher or lower that I think are important, because at the end of the day, I can explain the math and all that, but the essence is pretty basic, right? There's 3 things that make the drive, what the price of a business is. The first is growth, right? So all other things equal, if a business is growing, they can pay more for it. It makes sense, right? If you think about, if you were to buy a piece of real estate to rent, and the rent next year is going to go up by a lot, you're willing and able to pay more than, if there's no growth, or to the contrary, it's shrinking. And, one thing is, when a business is shrinking, often there's kind of a heavy penalty in terms of valuation that the business owner confronts out in the market, right? The second is risk. Ultimately, at the end of the day, people will only pay up for something that has a low level of uncertainty. Or in other words, certainty is what drives higher valuations, right? So risk comes in a lot of different ways. It can come in industries, for example, that have a lot of cyclicality. Certain businesses that, and I'm an investor in a John Deere dealership, so the big green agricultural tractors. Well, for better or for worse, in that industry, you typically have 6 years where things go up, and then 2 years where things go down, and it just is the way that the cycles work. There are other businesses, though, that essentially are almost immune, right? And so the less amount of risk and the more kind of uncertainties that you can eliminate, the higher the valuation.
You said some of those businesses are immune. You got to tell me what those are, because that's where I need to invest.
I mean, look, the reality is with AI and everything, it's anybody who's saying that a business is riskless, I think has never really been a true business person, right? I always say that I, in college, did all these business plan competitions and all that, and I thought I was an entrepreneur, but it wasn't until I lost my job and started my company 15 years ago, and my bank account started going down every month, where you start understanding what it feels like to be, an entrepreneur, right? And ultimately, everybody who's gone through it has been there, right? But when you think about, there are certain industries that are more essential and essentially essential services. For example, there's a tremendous amount of private equity appetite in the current moment in things like home services. So you'll find air conditioning repair. There are some large consolidators out there that are paying, often 8 to 10 times their annual profit, and for large companies, well above that, because their thesis is, looking at the region, nobody's going to go without air conditioning. The population is growing. There's a limited universe of people that know how to fix it themselves. So pretty much, the price goes up. You're gonna pay it. Yeah. And so there are a lot of other businesses like that. Healthcare has some aspects of that, but I think it's important to distinguish between, is the industry going to continue, and can I continue to make high profits? And those are two different things, right? It's guaranteed that, in healthcare, you're going to have primary care because society needs it. It's going to happen for the next 100,000 years, whatever. The question, though, particularly with, Medicare setting their rates and all that, is the profitability going to be high, right? And so it's the intersection between something which has long staying power, but also the ability to continue to sustainably earn a profit. And the third is a hodgepodge of factors, which I call supply demand. And what I mean by that is, if we remember back in our economics class, the more demand that there is, the higher the prices are. And conversely, if you have a lot of supply, prices not as much. So thinking about, if you've got a lot of the same type of business in the market at the same time, pricing is generally going to be lower because the buyers can say, well, if I don't buy this business, I'll find another one more or less to buy. The last thing I want to mention is I want to tie that to the investment strategy that private equity takes. So basically, I like to look at the world as of scale and below scale in terms of businesses. What I mean by that is, going back to the private equity analogy, that they basically try to consolidate. What they're often doing is they're finding what's called a platform business. So they're finding an initial business which is big enough and has the infrastructure, the financial means, the wherewithal to essentially go out and buy smaller businesses and absorb them consistently. Okay. And 9 mothers doesn't make a baby any faster. So you can't just get some small informal business to do that. You need to have one that has the technology, the systems, everything in place in order to do that. So if a business has that, and in general, it depends on the industry, but in general, a business needs about $3 to $5 million of annual profit. Once it reaches that level, depends on the industry, but you essentially open yourself up to the entire universe of private equity firms. There's about 2,000 that exist in the United States, and currently there's about $1 trillion that they have of dry powder, meaning money that they have not currently invested. And actually, if they don't invest it, they lose it. So they have a huge incentive to want to go and put it to work. So that entire universe, could be a buyer, right? But if you're of subscale, meaning, you're just $1 million or $2 million, well, before private equity existed, and private equity actually is relatively new. It exists in in this size range just in the past 30 years. Before private equity existed, the only person you could sell to essentially would be another local person who gets an SBA loan and buys that business. So when you're selling that business, the only buyers are people that have a pre-existing business in your region, in your industry, and have the financial means, the money to do it.
Yeah.
So you go from, let's say, 300 potential buyers to, let's say you're a small business in, air conditioning repair. You may only be able to sell to 3. And so that's what ends up resulting in the larger one having a much higher valuation, because it just has such a much larger universe of potential people that can buy versus, that small number that say, well, if you don't really make it worth my while, I'll go look at something else, or, I'll invest in my own business.
Okay. So what are some of the most common mistakes that these business owners make when they're trying to grow or sell their business?
So I'll start with the grow, and then we can.
Okay.
Look, I don't think that there's no right or wrong around deciding to sell or not. That's a very personal decision. But if you do want to ultimately sell, there are certain types of growth that are not as valuable.
Wait, growth not valuable? What? Tell me more.
So what I mean by that is, going back to what I just talked about, private equity likes to consolidate things that are essentially very similar. Okay. So what's not a good fit for growth is essentially to try to build a conglomerate. So it might be good for you and your lifestyle, you may enjoy it, there might be opportunities, but often I find that, particularly my clients that come from Latin America, where they may own a bank, and then own a grocery chain, and then they own something else. The problem is that there is no singular buyer for each of it. And going back to what I described before, that big things trade at a higher multiple than small things, what functionally occurs when they try to sell the business is the reverse of that phenomenon, right? Which is that now you have to sell it in pieces, and each one individually is going to sell for a really low multiple. So when you do grow, I think that there should be a premium placed, particularly if the goal is to ultimately sell it, to acquire stuff that essentially strategically makes sense together, right? So if you own a dentist, chain, don't go and put something which is totally different from it. You can go into orthodontics or some of the specialties or whatever. Because what happens is, if you have all those other things, is one of two things, neither which is good. The buyer is either going to say, hey, you've got all these other assets that you value, but I don't want it, and I'm not going to pay you anything for it. Okay. Or you basically are going to, you're going to have the limited universe of buyers where maybe one or two would say, yeah, I'll buy the whole thing, but you eliminated all the other people that potentially could be a buyer. And at the end of the day, when there's only one person that can buy your business, or two people, it's very difficult for you to get the full value that you deserve, that you put your life's work into. So to me, that's the first, because a lot of times people with a lot of entrepreneurial talent and drive will come across these different opportunities and start collecting. And so just being aware of that, I think, is important. The second on the growth front is, growth without profitability generally is not going to get you much, right? Ultimately, it's a lot more stress and headache that you're going to have to go through. But the way that an investor is, pretty much every investor values the business, is what, going forward in the future, will this business provide me as an owner? And so it has less to do with, what's on the top line, and more around, how much do you ultimately get to keep. Now, there's a limit to that, in that, ultimately you can only cut costs so much, right? And so the ideal scenario is you maintain a consistent level of profitability and you grow. And what I find is helpful for businesses in that situation, two things to look at. One is to look at your internal business and look at your information and say, okay, where am I currently making money? Where am I currently growing? Let me talk to my people on the ground. What are they telling me around where there's opportunity that I should be investing my time and energy and money into? Because a lot of times people don't necessarily subdivide it and look at it that granularly. But in every business, you typically have certain areas that are doing really well and others that you may not have even realized it, but you may be losing money. So really focusing and analyzing your own business and deriving those insights from the inside, I think is valuable. And then the second thing is, I think, looking from the outside, which is looking at, for example, what is currently occurring in the market. Where is private equity currently investing? What are they prioritizing, right? For example, going back, it just is in my head today, with air conditioning, there are higher premiums paid for residential air conditioning repair companies than for people that do commercial and industrial, right? So if you were a business owner and you know that, then you'd say, you know what, I've got both, but I'm going to spend my time, I'm not going to just cut one off, but I'm going to spend my time now putting all my energy into, building up the residential side. And so that type of, research and effort, I think, is helpful. And then continuously, monitoring and iterating, because, you have a business plan, you hope it goes according to plan, but your initial thesis of what could work or should work may not, transpire. So it's continuously refining and improving, and, ultimately, that's how you get.
That's how you get it.
Yeah.
So you've helped negotiate billions of dollars in deals. Can you share some real-world stories where owners successfully followed these principles to achieve a strong exit?
So it actually was one of my earlier transactions, and it was a business that actually started helping them more from the strategy side. And so ultimately, in a lot of ways, I helped them implement the private equity playbook of, let's say they were at 100. They produced essentially a product that was sold throughout most home improvement stores throughout the country. And ultimately, they had a number of different growth plans to expand to new geographic locations, but also to expand their product mix. And so ultimately, over a 2-year period, and quite frankly, without an intention to sell, they went through this exercise of just trying to improve the value of their business. This was a family business, and they had some family members in it, and they had some family members that were not in it. And ultimately, their objective was to make as strong of a business as possible. And through that process, though, they developed the discipline of both collecting the data to be able to help them make good informed decisions. They also had the discipline of holding themselves accountable to these essentially weekly, monthly, and quarterly goals that they put in place. Long story short, over those 2 years, they grew nicely, probably 50 plus percent. And ultimately, different factors emerged where somebody proposed the idea of them taking a minority investment. And that essentially had them decide, well, if we're going to accept that, maybe we should look at what it would look like to sell the whole thing and what that would be worth, and to make sure there was something that was fair. And ultimately, the decision in those conversations was made to sell the business. And they had a great financial exit. Interestingly, and this is from our conversation before the panel, they sold 80% of it, but the operator, who was a family member or was married to the family, he essentially afterwards said that it's improved his quality of life significantly because it took out some of the family dynamics. Specifically in their case, everybody has an opinion, and in particular, a lot of times the people who are not working in the business have a very strong opinion of how things should go and all of that. And so eliminating that and having it run just purely like a traditional multinational or whatever provided him a much better quality of life and minimized, quite frankly, a lot of the friction that was occurring, within the family.
For a little bit of clarity, David and I were talking earlier, and we were talking about family businesses, because I know traditionally in a lot of Haitian households and immigrant households, we tend to start a business so that the rest of our families can sort of take over, or we have them join us. And I was telling him, in my instance, when I went into business with my father, it was catastrophic. And the best decision that we ever made was to part ways. And so this is what we were talking about a little bit.
Because I think
Yeah.
ultimately, people talk about selling from purely the financial standpoint, but a lot of people are motivated to sell for reasons outside of, obviously you want to receive the money, but sometimes it's because I want a quieter lifestyle. I want less stress. I want to be able to take a vacation with my family. Other people actually want the exact opposite. They want to go and grow more aggressively, but they don't want to fund it with their own money, right? Other people want to be able to have a solution that allows them to disperse money amongst the family members without their creating subjective perceptions that one person got a better deal than somebody else. So there's a lot of different reasons why people turn to selling. And I think it's also really important to just mention that, and in some ways my book is mistitled. Selling implies a binary thing. You either sell or you don't. But the reality is there's a lot of permutations in between. You could sell a portion. You could actually do what's called a debt recap. So you could take a large special distribution from the company that's funded by a loan that's non-recourse against the business. So there are a lot of different things. Ultimately, the common thread around why most people do a transaction is because they want to secure their family's future and diversify and kind of compartmentalize it outside the business, because, as we mentioned a little bit earlier, while you try to do everything you can to de-risk the business, there's no guarantee, right? And so a lot of times it's the motivation to say, you know what, I want to make sure that, God forbid something happens, at least my family is taken care of, financially.
Yeah. So this is going to be the last and final question, and I think I might have time for one question. So thank you so much for everything that you just shared.
Sure.
I love this sort of thing. But for everyone, what is that final thing? Like, after you leave today, I'm a business owner, I am thinking about selling, I'm mid-market, I'm ready. What do I leave here today doing? What do I do? What's my next step?
Yeah, so I think the most important thing is really to educate yourself and to start preparing, because interestingly, we find that only about 1 out of 4 business owners come to us and have done any preparation. And the reason is the urgent pushes out the important. I get it. It's hard enough. You're trying to, every spare moment you have, you want to spend with your family, or, it's difficult to work on the strategic things on your business. What I mean by educating yourself is, when you sell, you are going to be going against professional repeat buyers. And so it's really important that you surround yourself with professionals that do this, consistently.
Basically, call David.
And even if it's not myself, the reality is, find somebody that you trust that fits with you to represent you, because there are a ton of studies and everything that show that you're going to make more money, you're going to close with a higher likelihood. And probably the most important thing is, these private equity guys are not in the business of charity, but 100% of the time they use an advisor to sell. But the advantage, most, pretty much all that I'm aware of, will have a conversation for free. And so at the worst, you're basically going to glean a lot of information from these individuals around what are they seeing out there, what do they think is driving the industry, and different industry insights that can help you run your business better. And I think it helps even if you don't intend to sell, today, but in 5 years, or maybe you don't really have any plan. Yeah. What is the true cost of that hour conversation, where they can help educate you on it, and then, coming up with a system that works for yourself, that you can actually implement some of those different things that improve the value of the business. Because ultimately, typically what happens is you'll brainstorm with your team and your family 60 different items that you could improve, right? But then what you need to do is you need to prioritize those items, right? Because you can't do 60 all at the same time. You do 60, you're not going to do any of them. So you need to basically say like, okay, then this month I'm going to work on this one, and then the next 6 months I'm going to work on these three, and basically break it down, which goes down to prioritization, right? So even if they're all valuable, getting that insight from somebody that can say, you know what, depending upon when you want to sell, I would choose these three as your first, or these three as your first, or whatever, can really help give you guidance and help you start.
Thank you so much. Any questions, or is KB going to run after me? Oh, there we go.
We have one question right here.
Good afternoon. Thank you for the information. Question is, I see online they're saying there's a lot of boomers selling their businesses. Where do you go to find that? And how do you find it, negotiate it, and so on and so forth?
So it's a great question. I have a little bit of experience in this because I did this a couple different times and basically found different businesses that I was able to buy. So demographically, it's a fact that baby boomers are getting older, and the average age of the owner of businesses is getting older. And so there's actually the expectation that by 2030, 50% of businesses will sell. So roughly call it 10% per year will sell. Unfortunately, because there's a stigma associated with selling, or maybe not a stigma, but there's a concern that when people know that you're selling, that it's going to be used against you, that your customers might leave you, your employees might get scared, all of that. It's not easy that you can just find a database and buy it like buying a stock. So there's essentially two different paths that people could take. Path one essentially is to go, and typically there's smaller business brokers that will have listings. And I believe if you go to I think it's the Florida Business Brokers Association, whatever, there's kind of like a consolidated group of listings of lots of different businesses that essentially are represented by a broker. The second approach, that's one. The second approach, which typically allows you to buy best, is if you can develop relationships with the business owners yourself. So essentially it means going out in the community, and it can be leveraging relationships that you have from an industry standpoint. It could be geographic relationships, it could be relationships within the chamber, whatever it is. But leveraging those relationships to essentially identify business owners that you can start a conversation with. And ultimately, when you start the conversation, you don't know their numbers, you don't know anything else. But the conversation is, hey, look, this is something that I'd like to do. Ultimately, let's sit down, understand more about your business. And ultimately, if there's some fit, then I'll sign a non-disclosure agreement and you'll share the more additional information, and then we can negotiate it. The one thing I will say is that is a long, challenging process. So on average, people that take that approach of trying to buy a business, it takes about 2 years. And my experience was a little bit over 2 years in terms of buying my first business in 2016. So it is possible, but it is, it is a very inefficient world that requires a lot of heavy lifting and a lot of, conversations and meetings and all that to connect the dots, because you'll meet, if you think about private equity, for every investment they do, they look at 100 investments most of the time. So it requires looking at a lot of things and if you're going to buy the right one, right? It takes that patience and discipline to make sure that you're buying something that's high quality at a good price.
Is it weird that I have a question now?
If it's a quick one.
It's a really quick one.
Real,
Sorry.
real
Katie's
rapid
going.
fire.
Rapid fire. I know we're here with entrepreneurs, and most people here have started their own businesses, but what would you recommend? Start your own business or buy one? Because sometimes you don't necessarily want to go through the process of starting the whole thing by yourself.
That's a great question. I think there's pros and cons to each. The value of buying a business is you are starting with already something that works, and you can borrow against it, right? So an SBA loan for a business that's pre-existing, and I know the rules changed in the past couple of days, but my understanding is, people can often borrow up to 90%, right? So That's a huge advantage that you get when you do, pre-existing, business versus, starting something from scratch where the bank is not going to be able to, to lend against it because there's not that history that they can lend against. That said, I think that it's really important to be sensitive to the culture, right? Particularly in a small business. Look, even a big business is only its people, right? It needs people to make decisions. It needs people to run the machines. It needs people to distribute it, to sell it. And so it's really important that that you have that operational skill set to be able to manage people and all that. In full disclosure, I've realized that's not my greatest strength. Some people are good at it, and it's important to know yourself, right? Because I've known people that have bought a small business, and basically the day after closing, everybody quit. And so there are risks that also are inherent in it, and so ultimately there's no right or wrong answer, but particularly if you understand the industry and you're an operator from it, often it's faster and much more profitable to, start by buying one.
Thank you so much,
Sure,
David. You
absolutely.
guys, definitely, I would recommend checking out David's book, Selling Your Business with Confidence.